It is now time to talk weekend property.
These days, investing in the property market isn't just for the rich.
Buying a slice of Australia can be done on a very tight budget, if you know how.
So here with their savvy advice are Bryce Holdaway and Ben Kingsley from the Property Couch podcast. Good morning to you both. Now, one of the biggest hurdles that many people face is finding the money for a deposit. So what can you do if you don't have the cash in the bank?
Yeah, it's a good question, Jane. I mean, what we're sort of talking about here is there's definitely a few options. One of the main ones that people forget about when they don't have a cash deposit is actually equity that they have maybe in their home. We've seen property prices, especially in Melbourne and Sydney, going up quite strongly. Now, there might be a bit of equity there that they can use for a deposit or a down payment to get that first investment property.
One of the things we've also been seeing, and I know a couple of my mates have done this to get into the market, is that they've buddied up. They've gone in on a property together. How does that work, and are there any pitfalls going down that track?
Yeah, that's a good way to do it because you might have someone who's got really good assets and lower income and someone with a higher income with lower assets, and bringing them together makes sense. And the other thing you can do as well is, Ben talked about equity. You could go to the bank of mum and dad to help with equity if you don't have that. So instead of just having that as a handout from mum and dad, you might sort of say to them, hey, look, let's do a joint venture where you come on the title as well, maybe 20 or 30%. And I'll take 70%. It gets them both on the ladder. They've both got something, some skin in the game. And if they buy the right property, it'll be a good investment for them.
There's got to be a big disclaimer here saying not every property surely is going to make you money. So I'm sure this comes down to research somewhere. How do you make sure that this investment property ends up making you money instead of costing you money?
Yeah, that's a good one because there's a difference between investment stock and investment grade. And the difference is everything's investment stock, but not everything is investment grade. So one of the rules that we have is you should look to buy a property that banks like. Because that's really a good rule. And for example, if you buy student accommodation or service departments or something that the bank makes you put in a larger deposit because they want to protect their risk, we would say that's a bit of a clue that might not be the best option for you to make money in the long term.
And not every property is created equal, so it's really important to understand that if you're looking for cash flow returns, then you might be looking at really low value properties. But if you're looking for long-term capital growth, then you may need to sort of head more towards the cities.
Well, that's a good point that you're just leading into there because, I mean, a lot of our capital cities are so expensive and people just can't afford it. Are there certain places that you should be looking if you're on a budget?
Yeah, we say have a look just outside the capital city job market. So in Melbourne, for example, maybe Ballarat or Bendigo, where you can still get access to a six-figure income whilst going a bit further out and there's a bit more demand there, or perhaps maybe the Gold Coast or the Sunshine Coast. And if your goal is purely for income and not necessarily for growth, you might consider some areas like far north Queensland in Cairns or Townsville where there's very good income opportunities. But one caveat we'd say is still avoid the regional mining towns because we think they're still fraught with danger.
So there's got to be some traps that people fall into that, when they're just desperate to kind of get in and get that investment and maybe they don't do the research properly. What are the traps that you need to avoid?
Yeah, great question, Jane. I mean, there's a lot of them out there. The big ones for us is, don't be incentivised. So make sure that if someone's trying to sell you a property based on the tax outcomes and all the bling and all the new things, that's not necessarily a good investment. Ultimately, we're after a return and we're not necessarily after reducing our tax. We want to get, positive cash flow or we want to get capital growth out of that property. So don't be caught up in buying the bling. Look at the underlying fundamentals of location, owner-occupier appeal.
And as I said before, avoid properties that banks don't like. So the way you think about that is look for something that has owner-occupier appeal, not investor appeal. And it sounds like a bit of a paradox, but as an investor, you don't want investor-style properties. You actually want properties that the majority of the market want because the owner-occupiers buy with their heart, not their calculator, and you want to take advantage of that.
And finally, make sure you don't get, seduced by incentives. So we see things like rental guarantees or rebates out in the marketplace. If the asset stacks up, if the property is a good investment, why do they need to add these bonuses? They shouldn't need them. The property should be fundamentally sound in a great location to buy.
Well, that's great advice there, Bryce and Ben. Thanks for joining us. Watch out for the sparkle is what I'm hearing.
Watch the bling.
Watch out for the bling. Thanks, gents.